Hi there, Brock Vandenberg, president of TaliMar Financial and fund manager for TaliMar Income Fund I. Common conversation I have with potential investors, especially investors that have been investing in trust deeds, is what are some of the advantages of a mortgage fund over individual trust deeds? And so today I want to kind of go over those top 5 reasons and kind of explore as to why these are important for trust deed investors or those that are moving into investing in mortgage funds. So let's go with the number 1, and that's diversification. When you invest in a mortgage fund, you're investing in a diversified portfolio of individual mortgages. So if the fund is managed correctly, no one loan should have a considerable impact over your return if that loan stops paying. You've got all those other loans within the portfolio that are paying, and therefore you're consistently earning your income on the fund. Now, this compares to individual trust deeds, where if you're invested in a trust deed, that borrower stops making payments, well, all of your payments stop until either you get paid off or you put something together, a payment plan for that borrower. Number 2 is going to be, and I think is the most important thing, is consistency. I can't tell you how often I get calls from trust deed investors that are looking to invest in individual trust deeds. We don't offer trust deeds anymore, but they're having problems finding a trust deed to invest in. In many cases, either the brokers they've been working with are no longer offering trust deeds, or that broker doesn't have enough trust deeds to offer to all of their investors. So what happens is that investor has that money sitting in a checking account, and they're earning no interest on that until they can find their next trust deed investment. The mortgage fund solves this problem. Once you invest in a mortgage fund, your money's constantly working because it's invested in a diversified portfolio of mortgages. If one loan pays off, it really doesn't influence or impact considerably the overall return of your fund. It's up to the fund manager to then go out and place that capital into another fund. So for example, for us, we have a little over 100 loans in our fund. If 1 or 2 loans are paid off, and you've got some liquidity on the balance sheet, it doesn't heavily impact the return of the fund for the investor. So number 3 are the tax advantages. And this is really dependent upon how the fund is structured. So our fund is structured as a REIT, a real estate investment trust. And some of the advantages a mortgage fund offers as a REIT, there's no income cap on qualified business income tax deduction. QBIT is something that was put in place in the 2017 Jobs and Tax Act. And it allows past income from a pass-through entity to be taxed at a lower rate. Now, there are some income caps in a lot of cases for that income. But because the funds are coming or flow through our REIT, a real estate investment trust, there is no cap on the amount that you can deduct from the income. Number 2, because it flows through a REIT, you're not subject to what's called a UBIT, unrelated business taxable income. And this is more for people that invest with qualified funds, so your IRA funds or retirement funds. When you invest in an investment that uses leverage and there's income generated, that income as a percentage of the leverage used can be actually taxed at ordinary income rates. And a lot of people that use qualified funds to invest are not really aware that they could be taxed at an ordinary income rate. They just think, well, that those funds are sitting in a retirement fund, therefore they're not going to be taxed. That isn't the case. So we talked about diversification, we talked about consistency, we talked about the tax advantages of it. The other big advantage of investing in a mortgage fund is the ability to reinvest distributions. So the number 4 reason that a lot of investors invest in a mortgage fund, especially those that have invested in trust deed, is the ability to earn compounded interest. Because in a mortgage fund, you can reinvest your distributions, and in our case, monthly, you earn income on that income, and that's considered compounded interest. In trust deeds, those funds are deposited in your account, and they don't earn any interest until you can redeploy them into another loan. And then number 5 is liquidity. And this is really important. When you invest in an individual trust deed, most likely you're not going to get your money back out until that borrower pays off that loan. In a mortgage fund, on the other hand, because the fund is made up of a large number of loans, the ability to get your money out is much easier. In a mortgage fund, a fund is liquid or the ability to get money out is based upon the number of loans that are paid off within the fund or the amount of investor capital that's coming into the fund. So if there's a large volume of loans paying off, for example, in our fund, we're averaging about 8 to 10 million a month in loan payoffs. There's sufficient funds to get to all the withdrawals in most cases. So those are the top 5 reasons why investors consider investing in a mortgage fund over individual trust deeds. To learn more about investing in a mortgage fund or even trust deeds, check out our YouTube channel. We post a lot of great content. If you're interested in learning more about our mortgage fund, feel free to reach out to my investor relations team. I'll put their contact information below. Thanks for watching.